Now, despite the strong performance of share prices over the past few months, we're not expecting a particularly strong earnings performance from this segment in the first half of FY24. So on average, we're forecasting a 7% decline in net income on a year-on-year basis. And now that's reflective of a pretty subdued consumer environment still, and of course some good old-fashioned operational missteps. Now the best growth in percentage terms is expected to come from none other than Step One, which is expected to continue to regain sales momentum, and has been the best performing share in our little universe here, up 300% over the past 12 months. The biggest decline in profits from Baby Bunting, down 30%. But of course, Baby Bunting pre-released its earnings last week, so we kind of know what they're going to be. Now, they underperformed analyst expectations, but there was enough suggestion of green shoots of recovery just to keep the share price steady. Now, another company in my universe that has already announced their profit is Super Retail Group. Super Retail lived up to its name with a very strong performance in 3 of its 4 brands, excluding Rebel, and that caused us to upgrade our full-year forecast by 8%. So it is a mixed bag coming into reporting season. But we do think there's going to be some consistent themes among the discretionary retailers' results this week. So I think it's likely we'll hear a lot about just how challenging the market is, the environment is for discretionary companies. And it certainly was a very weak end to the year. The retail sales numbers out yesterday showed a 2.7% decline month on month, which is pretty weak, worse than we expected. And that's a sharp decline in trade, particularly in shopping centres where the footfall declined by double digits for various reasons. Consumer sentiment remains in the doldrums as well, although it's not getting any worse. And if we do start to follow the lead of the US consumer, we might start to see that track up in the months ahead. Another key theme is that the environment is highly promotional. We've heard this from everyone we speak to. So consumers are really only transacting when they can find a good discount and a good deal. And that was especially apparent during Black Friday, which went for longer and offered bigger discounts on stock, on products than we've previously seen. And that supported a reversion of the growth in online penetration, which did correct after COVID, but is now back steadily into growth. So coming into the stocks, who do we think is likely to deliver us a positive surprise over the course of February? First on our list is JB Hi-Fi. Now, consumer demand for electronics was literally off the scale over Black Friday. It was by far the best performing sector in November. And we see JB Hi-Fi as a key beneficiary of this. And now JB Hi-Fi has about 30% share of the Australian consumer electronics market. So they have the scale to buy better than their competitors, including the likes of Godfrey's, which sadly yesterday went into administration. We think that will support JB Hi-Fi's gross margins in February. It is also the master of operational cost control. It has the best ratio of operational costs to revenue of any of the stocks that I cover. And I expect it to have adjusted its cost base downwards to adjust to the more subdued sales environment. So while I think the earnings will be down materially year on year after a bumper PCP, we think there's every chance that the market has underestimated the resilience of this business. We're 4% above consensus. We see it as a positive surprise candidate, but we're not calling this one to buy into results, largely because I do believe that the stock has run pretty heavily into results, up about 20% over the last 2 months. Perhaps in anticipation of what I think is going to be good news. And it's trading on 16 times forward PE, which is well above its historic averages. The second one is a less well-known company, The Reject Shop. Now, this has been going about its business rather quietly of turning the business around in recent months. It's improved its lease and labour cost efficiencies as it continues to target a doubling of its EBIT margin over the medium term. Its new chief operating officer has overhauled the merchandising range of TRS. It's reinvigorated the kitchen, the home decor and garden products range of this business. And at the same time, they're seeing an influx of consumers coming into the store seeking better value on consumer essentials, that they can get better prices here than in some of the supermarkets. And as one consumer recently commented on TikTok, Reject Shop be slaying it lately. And I'm told that's a good thing. So we expect the Reject Shop will report positive earnings growth in the first half of 24 and declare its first interim dividend since 2019. Now, on the other side of the ledger, we are nervous about Adairs and BRG Group. Now, Adairs said in its AGM in November that the traffic trends in all three of its brands were exceptionally weak, both online and in store. Now, homewares is a very competitive space, particularly in the current subdued consumer environment, and we're not convinced that Adairs is winning the battle. And at the same time, Adairs recently took over the running of its national distribution centre in Victoria, taking it over from DHL, which couldn't make it work. And this is going to be the first result where we see if Adairs is able to better run a distribution centre than one of the world's largest logistics companies. Forgive me for being a little sceptical. Adairs cancelled its dividend in August, and I do not think you can rule out the possibility of them doing that for the interim dividend as well, despite the fact they assured shareholders in August that they would be resuming payouts in February. In contrast to BRG, the market does expect steady positive growth. Sorry, in contrast to Adairs, the market expects steady profit growth out of BRG Group, which is the company formerly known as Breville. Now, I think that's not necessarily a given. We've heard from a lot of multinational appliance companies that the demand for kitchen appliances in particular has been pretty weak recently. And I think looking at 7% forecast EBIT growth that the consensus number has may be a challenge to achieve that. But what we're actually more worried about is inventory. BRG has pumped up its inventory recently. And I think if you don't see it come down the 12% the consensus is expecting into February, then that is going to be taken negatively by the market in terms of a read across for demand and destocking from their retailer customers. So at 33 times PE 1 year forward, there is no tolerance for that sort of misstep. So I'd be nervous about that at this price, given that it's had quite a run. And then finally, I couldn't do a presentation like this without mentioning Lovisa. So while it's not one of our key positive or negative surprises, because we're not really expecting anything particularly groundbreaking out of this result, it will be of great interest to the market. The net additions over the course of the first half have been quiet. We're forecasting 58, which is very quiet by Lovisa's very lofty standards. That works out to be an expansion of only 7% of their footprint, which is half the rate that they did, 14% this time last year. But to us, this is really just noise. Lovisa has just opened its first store in China, which is the picture that you can see behind me. So they'll be on tenterhooks to find out just how well that's going and what their plans are for this market. It literally could hold hundreds of Lovisa stores. Not today, not tomorrow, but in due course it really could. So let's see them talk about that. And don't forget that it also opened up in 12 entirely new countries last year. And so these countries could be big for Lovisa as and when it chooses to hit the accelerator. So a slightly quiet period to December is really not something that bothers us. The other thing that people will be focusing on is the like-for-like sales trajectory, which was negative at the AGM. We're not used to seeing negative like-for-likes from Lovisa, but it is coming off a very, very high PCP. And we do expect there to be some positive traction in like-for-likes over the course of the first half. So having reported minus 6.2 at the AGM, we've got minus 4 for the half as a whole. We are in a pretty challenging and volatile consumer environment. I think that's clear. But we do see some real opportunities in the February reporting season. I flagged JB Hi-Fi as a potential positive surprise candidate, believing that the current discount-focused nature of the market is going to play well to its business model. Also mentioned the turnaround at the Reject Shop as the reason to be positive into the results. I called out Adairs as being at risk of cancelling its dividend and BRG Group at risk of disappointing the market on inventory.